All right, so today we are going to do IS-16, which is property, plant, and equipment. Now, obviously, from your previous knowledge, you know that we have two main types of the assets, and which is tangible, non-current assets, and intangible, non-current assets. Tangible non-current assets and intangible non-current assets. You have studied this thing in your previous accounting papers. Now, tangible non-current assets are the assets which have the physical existence. Tangible assets mean which have the physical existence, like for example, building, like for example, motor vehicles. These are having the physical existence. Intangible assets are those assets which does not have the physical existence, like for example, license, for example, copyrights, for example, formulas, for example, softwares. These are the intangible non-current assets which does not have the physical existence. Now, when we were dealing with the basic accounting, we do not use to classify these topics of the assets into separate standards. But now we are in the strategic level paper. We are doing the accounting for the companies. So we have to know each and everything in detail. We have to know like which type of assets should be classified in this standard. Because when you are dealing with the companies, when you are dealing with the corporate sector, there are so many things you will be facing. There are so many things you are looking at. So at that point, you need to understand the standard in the detail, that if we are studying IS-16 right now, what assets comes in under the scope of the IS-16 and which things are excluded from the IS-16. Now, the tangible non-current assets, they have two standards. The one is the IS-16 and the other is the IS-40. Both are the tangible non-current assets, but they have the different standards. Now we have to understand what IS-16 is all about. So, scope. What things we are going to classify under IS-16? First of all, these will be the non-current assets. And the non-current assets, you know that the assets which have life of more than 1 year. The first thing is the non-current asset. Life is more than 1 year. The second thing is that these are the tangible non-current assets. That means which have physical existence. The third thing is that these assets should be for business use. These assets should be for the business use or the use in the business. Now, business use means that these assets will be used in the business, such as in the production, such as for providing services. Like for example, if I say you that there is a college, and in the college there are classrooms. In the classroom there is a furniture. So that furniture is the property, plant, and equipment, because the college is using that furniture to provide the classes to the students. In the manufacturing entity, for example, which manufactures headphones, they have the machinery. So that machinery is used to manufacture the headphones. That machinery is the property, plant, and equipment. For example, there is an electronics company, and in the electronics company, they have the machinery which is used to make the air conditioners. So that machinery will be classified under PPE. For example, there is an airline industry which have the airplanes. Now that aeroplanes are used for the transportation, for the activities of the company. They just cater the passengers and they fly from one place to another. Those aeroplanes are the property, plant, and equipment. So remember that in the scope of the IS-16, They first of all should be the non-current asset. That means life is more than 1 year. Then you have the tangible asset. That means it should have the physical existence. And then it is should be only for the business use. That means for not for sale. Now, not for sale means that we are not selling those things in the ordinary course of business. Like say for example, if you have the air condition in your office, that AC is the property, plant and equipment, because that is used for the business. But if you go to the electronic shop and there will be ACs over there which they are selling, for them the ACs are inventory because they are selling it. When we say not for sale, that means we are not selling it in the ordinary course of business. That doesn't mean that we cannot sell it, because there will be a point, like for example, if I have the machinery which is used to manufacture headphones, maybe there is a new machinery in the market which is more technologically updated. I have to change the previous one, so I'll be selling the old one. That is another thing. When we say not for sale, that means we are not selling that thing in the ordinary course of business, or business is not selling of the machinery. We are just selling it because we need the new one. So non-current assets, and these should be the tangible non-current assets and should be the assets for the business use, and these should not be for sale. Okay, and we should not sell it in the ordinary course of business. If this is the thing, that means the criteria of Ias-16 is met. Now this scope means that these assets will come under the Ias-16. Now you need to understand what is asset. Now what is the criteria for asset? The criteria for asset is, first of all, the control. Now control means that you have the risks and rewards. The second thing is, it is probable that economic benefits will flow to the entity. It is probable that economic benefits will flow to the entity. Now the first thing was control. Control means that you have the risks and rewards related to that asset. There is a concept in the accounting which is known as, which is substance over form. There is a concept in the accounting which is known as substance over form. Now the substance over form means that there are two things. One is commercial substance or economic reality. The other thing is legal form. Like say for example, if you go to the bank and you lease a car, till the point when you have made all the payments, the car will stay on the name of the bank in the legal papers. Once you clear all the payments, and then the car will be transferred to your name. But till you are making the payments, the legally car will be at the bank's name. So if you see the legal form of the car is not yours. But if you see the commercial substance, economic reality, then car belongs to you because you have the control. You are using it, you are enjoying the benefits, you are bearing the losses, and everything belongs to you. You are keeping it, you have the physical control. That means in the legal form, it belongs to bank, but economic reality is that this is your car because you are taking the benefits, you are uh, enjoying the rewards, you are dealing with the risks. So that means the car is yours. Control, that is control. It is probable that economic benefit will flow to the entity. Now we can only classify asset if there will be some economic benefits. Now economic benefit doesn't mean that some inflows will be coming. Economic benefit can be anything, like for example it can be the inflows coming from the asset. Like for example, there is a machinery, we will make the units, those units will be sold in the market, so there will be money. Economic benefit can be in the form of saving as well. Like for example, if you have like an instrument which saves you electricity, this is economic benefit as well. So economic benefit doesn't mean that something should come in the form of money. It can be anything. It is probable that economic benefits will flow to the entity. And the third and main thing is cost can be measured reliably. Now this means that you can assign the value to the asset, because obviously the asset should be recorded in the statement of financial position. In the statement of financial position, you have the monetary values. So if you want to record the asset over there, that means you should be able to assign a reliable value to your asset. That what is the worth of this asset? If the cost cannot be measured reliably, if you cannot assign the values to that thing, that should not be called as an asset. So the three things, and these two ones are the major things. That is, it is probable the economic benefit will flow to the entity, and cost can be measured reliably. So this is the criteria of the asset, and this is the scope of the property, plant, and equipment. So anything which does not fall in this should not be recorded in the Ias-16. And what are those things? We can now discuss the exclusion. Exclusions. Exclusions means those assets which does not fall under Ias-16 criteria. For example, asset held for sale. Now, for example, if you are having the asset which you are now selling, like for example, you have the machinery, you are using it for the business, but now you have decided to sell it in the market. So that will not fall under Ias-16. Previously, although it was in Ias-16, but now it should be transferred to IFRS 5. So there is a new standard for that. So for example, you are having the machinery which you were using for the business. So that at that point it was in Ias-16. But now you have taken the decision to sell it, so it should now be transferred to IFRS 5, which is held for sale. Similarly, asset held for capital appreciation or to earn rentals. Like for example, you have a building which you have given on rent. For example, you are having two buildings and two adjacent buildings. In one building you have your office, the other building is on rent. You have given it on the rent and the company is enjoying the rentals. So that building which is producing the rents should not be classified under Ias-16, and it have a separate standard which is Ias-40. Similarly, if you have a property which you have held for capital appreciation. Now, capital appreciation means that you have held that asset to enjoy the increase in the value. For example, you bought the building for $100,000. Now you want to have increase in the value of this. Like for example, after 1 year it will reach to $120,000, and after another year it will reach to $140,000. So you have held it for capital appreciation. So that comes under Ias-40. So if an asset is held for capital appreciation and to earn rentals, not for the business, it should come under Ias-40. Similarly, assets sold in the ordinary course of business. Assets sold in the ordinary course of business that you are selling as part of the business is your inventory, not the PPE. It should be recorded in the IS2. So these are the exclusions, that these assets should not be recorded under IS-16, and only assets which are non-current assets and the tangible ones and they have only business use. That means, for example, machinery which is used for production, assets which are used for providing services, and things like that, and these are not for the sale, should be classified under IAS-16, which is property, plant, and equipment. As the name suggests, property, in which the normally businesses have offices, and plant and equipment means which are used to manufacture, which are used to make the inputs, units which are being sold in the market. All right, now we have the initial measurement. Now you have the initial measurement. Now, initial measurement means that at what value we will be recording the property, plant, and equipment initially. Initial means at first place. That when the first time we are recording the asset in the books, at what value it should be recorded. So initial measurement, so the PPE should be initially recorded at cost. PPE should initially be recorded in the books at cost. Now, what is this cost? Cost means cost of purchase. Cost of purchase plus any cost to bring the asset in the working condition. Cost of purchase, cost of purchase, cost of purchase means, like, say for example, we bought a machinery. Now we bought a machinery for the production, so the amount we have paid to the supplier is the cost of purchase, plus any cost to bring the asset in the working condition. Now we have bought the machinery, any cost to bring the machinery in the working condition. Now what do we mean by that? Any cost to bring the asset in the working condition. For example, site clearance, site preparation. Now, for example, where you want to install the asset, you are making this place clear, you are preparing it for the machinery, such as professional fee. Now, professionals are coming to install it, to check it, to run it initially for you. Professional fee, transportation, legal duties, which is non-refundable. For example, you have imported that machinery outside the country and you have paid custom duties. So legal duties, non-refundable. Variable overheads, which is related to the production overheads. Similarly, you have dismantling, or it is also known as decommissioning. It is also known as restoration cost. So site clearance, site preparation, professional fee, transportations, legal duties, variable overheads, dismantling, etc. Or you can say this: any direct cost any direct cost. Now the direct cost means the cost which is directly attributable to the asset, the cost which is necessary to bring the asset in the working condition. All of that should be capitalized. All of these costs should be capitalized. So cost means these should be capitalized. Capitalized means that this should be the part of cost, initial cost, cost of purchase plus any cost to bring the asset in the working condition. Now we are discussing the last one, this dismantling, decommissioning and restoration in detail, because this is important. The rest is simple, like site preparation, site clearance, professional fee, that is quite clear, custom duty, everyone knows that. Now dismantling or restoration cost. Now first of all, it is your legal or contractual duty to dismantle the asset or restore the site. Now say for example, you have actually installed the heavy machinery on the government land to extract the oil. Now actually you are actually an oil company, and you are going to extract the oil. So you took the land, or you have taken the land on the lease, and you are extracting the oil. So you have installed heavy machinery on the land when you are extracting the oil. So now say for example, the government says you that, okay, take out the oil, and obviously we'll be charging you this much for that. But when you are leaving the site, you have to dismantle the site, or you have to restore it. That means you have to bring it in the original condition. Obviously they can, for oil they will be digging it. So when they are digging it, once they extract the oil, then they have to restore it. So dismantling or restoration cost means that sometimes when you are installing the asset on some place, you contractually you have to restore the site, or you have to bring it in the original condition. So legal or contractual duty to dismantle the site, and this cost belongs to the future. That obviously, for example, you have to dismantle the site after 5 years. So this expense of dismantling or restoring will be occurred in the future. Now this will be estimated. Now this will be estimated. That means today you are going to estimate this expense, that what amount you will be paying to dismantle this site after 5 years, for example. So now you will be estimating it. So this is an accounting estimate. So this is an accounting estimated, because you have to estimate it. Now this belongs to the future. This belongs to the future. So we have to calculate the present value today, as you did in F9. So present value equals to future value multiply 1 plus R raised to power minus, and this is the formula. So R is equal to rate of interest, which we use to discount. N is the number of years. So as you know, when we are bringing the future value to the present value, this process is known as discounting. So let's take an example. For example, an entity is obliged to restore the site after 5 years. They have estimated that $200,000 will be spent to restore the site after 5 years. The interest rate or the cost of capital or rate of interest is 10%. Calculate present value. Now this is the data and you have to calculate the present value. This is the data, you have to calculate the present value. So how you will be calculating it? Present value, which is PV, equals future value, which is FV, 1 plus R, which R is the rate of interest, minus N is the number of years. So future value is the 200,000. 1 plus R is 10%, so we take in decimal is at 0.1 minus 5. Now we have to solve the bracket first, so you will use your scientific calculator. So 1 plus 0.1 raised to power minus 5. It gives you 0.620. So 200,000, 0.620. So we multiplied by 200,000. It gives you the present value, which is 124184.2. That means the present value of $200,000, which will be spent after 2 years, is 1,24,184.2. So this is the present value today. Now what we're gonna do is we're gonna pass the double entry, debit asset, because this cost is capitalized. So 124,184.2, and credit is the provision for dismantling. Now why we are calling it provision? Because provision is a liability of uncertain timing and amount. Here we are sure regarding the timing that after 5 years we will be doing the restoring or the restoration, but the amount is unsure because that is estimated. So if we are estimating the future amount, that is known as provision, liability of uncertain timing and amount. So 124,184.2, 1,24,184. So this is how we calculate the present value. Now there is one more concept attached to it, which is unwinding. One more concept attached to it, which is unwinding. Now the unwinding is quite easier to understand if you focus. Now we have recorded the liability in the T account. If you see, let's make a T account over here. Let's make a T account. And this is the T account for provision for dismantling. And we have recorded the opening balance of the liability as 1,24,184.2. This is the opening balance. Now, ultimately, what amount we have to pay after 5 years? 2 lakh. So that means we cannot record this 1,24,184.2 as a liability for 5 years. We have to increase this systematically every year so that by the end of the 5th year, it reaches to 2 lakh automatically. So we cannot keep this 124,184.2 throughout 5 years because ultimately we have to pay 2 lakhs. So every year, systematically, we are going to increase this liability by the same percentage we have used for discounting. So in the year 1, what we're gonna do in the year 1, we take 184 multiply by 10%. So 124,184.2 multiply by 0.1. Sorry, multiply by 0.1. It gives you 12418.42. Now what we're gonna do, we're gonna add this thing, debit profit or loss, credit provision. With this amount, we will increase the liability 12418.42. 12418.42. So you look, this provision account is credited. So provision account is credited by a profit or loss 12418.42. So what is going to be the closing liability? 12418.4.2. It is now the closing balance will be 136602.62. This is the closing balance of the liability after first year. So that means the closing liability after year 1 is 136602.62. Then there will be year 2. So now at the start of the year 2, we have the opening balance of this 136602.62. Now again we do the same thing. 136602.62 multiply by 10%. Multiply by 10%. So it gives you 1366.0.262. Now again we pass the same entry, debit profit or loss, credit provision with the same amount. Then it gives you the closing liability. Closing liability of what? 136602.62. So it gives you the closing liability of 150,262.882. This is the closing liability after second year. Now again this will be done in the year 3. So when you do till year 5, by the end of the year 5, this liability will automatically be 200,000. So now again listen the concept. So the amount we have to pay to restore the site is known as dismantling and decommissioning. We have to capitalize it because that is the direct cost of the asset. So because this is the future cost, we will be calculating the present value. and we capitalize the present value today. We also record the provision, but we have to pay the full amount ultimately. So every year we systematically unwind this thing. That is known as unwinding. So when we do the unwinding with the same interest rate through which we have discounted it, after 5 years it will reach to the original amount of 200,000. Okay, this was the initial cost. Initial cost means the elements which we are going to capitalize. So that is cost of purchase plus any cost to bring the asset in the working condition. Now we will be discussing the elements which should not be capitalized. 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 Now, the elements which should not be capitalized is first of all training cost. Like for example, if you are implementing the new assembly lines, the new technology, the new assets, and you are training the employees to use that, so that training cost should not be capitalized. What is the reason behind that? Because you are training the employees, and employees can leave the company, they can go in the other companies, they can die, they can get insane, so that there is no control over the employees. So training cost does not meet the asset criteria and should not be capitalized. Similarly, refundable duties. Refundable duties is simply what you will be getting back. So the amount which you have paid and you will be getting back, it should not your expense. So that should not be capitalized because you are getting the amount back from the government. For example, you bought the you bought an asset and you paid the duty and the government says we'll pay you back. So refundable duties should not be capitalized. Similarly, abnormal wastages and abnormal costs should not be capitalized because that is because of your own mistake you are doing that. So abnormal wastages should not be capitalized. Similarly, fixed overheads, only production overheads and directly attributable overheads should be capitalized. So fixed overhead should not be capitalized, etc. So these are the things. These should not be capitalized. So if these are not capitalized, what we should do instead, these should be expensed out. So if we cannot capitalize it, we will be expensing this out. So we're gonna expense out these things. Next thing in the standard is subsequent expenditure. Now, subsequent expenditure means the amount which you are spending after the initial expenditure. What should be the treatment of the subsequent expenditure? Like the amount you initially spent it, which is the cost of purchase plus any cost to bring the asset in the working condition. Now you have the subsequent expenditure. So in the subsequent expenditure, the first thing is capital expenditure. Now you have studied so many times these things in your initial accounting papers. So capital expenditure, capital expenditure and revenue expenditure. You've studied so many times these things, but let me repeat again. capital expenditure and revenue expenditure. Now, capital expenditure is, for example, any expenditure related to acquisition, like, for example, you are buying something, expansion, you're expanding something, upgradation, you are upgrading something, improvements, extensions, etc. Now, say for example, subsequent expenditure means that you are doing further expenditure after the initial expenditure. So, if it is of capital nature, for example, you are buying something for the asset, any instrument for the asset. Expansion means like you are, like for example, expansion extension means you are having the one warehouse, now you are expanding it to two warehouses. Upgradation and improvement means, for example, the machine used to prepare 1000 units, now you have done some improvements in it and now it can prepare 2000 units. So that is improvements and upgradation. So if the expenditure is of capital nature, then it should be capitalized. If the expenditure is of capital nature, it should be capitalized. Now the capitalized in the statement of financial position. And what is going to be the double entry for capitalization? Debit asset, credit cash. So any subsequent expenditure of the capital nature should be capitalized. Now you have revenue expenditure such as expenditure on the non-current asset, and it is related to maintenance, repairs, or day-to-day expenditure. Such as, for example, you are using fuels, plugs, uh, oils, for example, yes, mobile oils. Non-current asset maintenance, repairs, and day-to-day expenditures, it should be expensed out. Where it should be expensed out? In the statement of profit or loss, and the double entry is going to be debit profit or loss, credit cash. So it should be expensed out. Debit profit or loss and credit cash. Okay, then you have subsequent measurement. Subsequent measurement, like initial measurement was on cost. Now you have subsequent measurement, or you can say year-end measurement. Initially, the property, plant, and equipment is measured at cost. At what value, at what model it should be measured subsequently? That means at the year end. So we have two models. One is the cost model and other is the revaluation model. One is the cost model and other is the revaluation model. Cost model and revaluation model. Now the cost model is cost less accumulated depreciation. It gives you the carrying value. A revaluation model is fair value, or you can say revalued amount. less subsequent depreciation. Again, it gives you the carrying value. Now we need to understand these things one by one. First of all, starting from the depreciation. Now you have studied this thing many times in your accounting papers. Depreciation is the allocation of cost over its useful life. That means when we buy the asset, so it has a useful life or economic life, for example, 5 years. So this asset will give the benefit to the entity for 5 years. After 5 years, this asset will be finished. It is not going to give any benefit to the entity. So then we will be writing off this asset from the books. So initially we recorded it and then we'll be writing off. So if we record the asset in the year 1 and then write it off in the 5th year, and in those 5 years it was recorded on the same amount, then it will disagree with the prudence concept. Now the prudence concept says that asset should not be overstated. Every year when we are using it, asset is losing the value because we are using it. So that means if we record the asset at the same amount over 5 years, then it will overstate the asset value every year, and it will breach the prudence concept, which says asset should not be overstated. So that means what we're going to do, we will spread this cost over its useful life because we are taking benefit for 5 years. So the cost should be spread over the 5 years as well. So depreciation is the allocation of cost over its useful life, and we have studied many times that we have two main methods of depreciation: straight line method and reducing balance method. Straight line method and reducing balance method. Now straight line method means minus cost minus scrap value. Scrap value is also known as residual value divided by useful life. Residual value means, or scrap value means, the amount at which the asset will be sold after the useful life. So it gives you depreciation per year. In the reducing balance method, what we do, we take cost and we multiply it by depreciation percentage. It gives you the depreciation. This is the first year. In the second and subsequent years, we take net book value, which is the carrying value. Now the carrying value is cost minus accumulated depreciation into depreciation percentage. So in the first year we multiply the depreciation percentage to cost, and then in the next year we multiply it to the carrying value. So in the reducing balance method, depreciation is charged on the carrying value after the first year. In the straight line method, it is the straight depreciation every year, same depreciation every year. Now there is no need to go in the detail because this is the concept from your earlier studies, studied so many times. Debit depreciation, credit accumulated depreciation. This is the entry. So in the cost model, we take cost and then accumulated depreciation is equal to carrying value. Accumulated depreciation is the depreciation we accumulate every year. So in order to calculate the carrying value of the asset. In the revaluation model, we take the assets which changes the value every year or every 3 or 5 years, whatever. In the cost model, we usually take the asset which does not change its value and they are systematically depreciated. In the revaluation model, we take the assets which changes the value. For example, building. No, building it changes the value. We take the building in the revaluation model. Similarly, machinery we take in the cost model because machinery will, like, after 5 years it will have no value, sometimes 10 years, whatever the nature of the machinery is. So fair value, that means revalued amount less subsequent depreciation. Now what is this subsequent depreciation? In order to understand this, you need to have a look at the revaluation. Revaluation. Now revaluation is when we take the asset from carrying value. Now carrying value is also known as book value, the amount in the books. So when we take the asset from carrying value to the market value. So revaluation means when we take the carrying value to the market value. That means whenever we are doing revaluation, we take carrying value and this carrying value at revaluation date, the date we are taking the asset to the market value, and then we take the market value at a particular date, which is the fair value, and the difference between the carrying value and the fair value is revaluation gain slash loss. Revaluation gain slash loss. So in the revaluation, we take the carrying value to the market value. Any changes is known as revaluation gain or loss. Now, remember, when you have gain, what you do, debit asset and credit revaluation surplus. And when you have the revaluation losses, so what you do first, you debit the revaluation surplus if there is any previous revaluation surplus. Now focus on this double entry. So when you have the upward valuation, you simply debit the asset and credit the revaluation surplus. When you have this downward revaluation, what you do, if there was any surplus related to this asset still, which is in the equity, so first of all you need to de-recognize that surplus. Any extra will be charged to the profit or loss and credit asset. So remember this thing, that whenever you are using, so this was upward, this is downward. So in upward, you straight away debit asset, credit revaluation surplus. In the downward, first of all, you see whether this asset was previously revalued. If this asset was previously revalued and there was some revaluation surplus, first of all, you need to de-recognize that. Once you de-recognize that, if still there is any downward revaluation, then extra expense goes to profit or loss and credit goes to the asset. All right, in the revaluation, we take the asset from the carrying value to the market value, and the carrying value is the book value, market value is the fair value in the market, and any gain or loss is reported in the revaluation surplus and the other comprehensive income. So I told you, when there's the upward revaluation, we debit the asset because increase in the asset is debit, Credit revaluation surplus. Revaluation surplus is credit because this is equity, and increase in the equity is credited. When there is a downward revaluation, first of all, we have to see whether this asset was previously revalued and there is a gain present in the equity. First of all, we will be reversing that revaluation surplus. If there is still some downward revaluation left, then we will charge it to the profit or loss as an expense, and credit goes to the asset. Now these double entries are for non-depreciating asset. Non-depreciating asset means such as land, we do not depreciate the land. But for depreciating assets, what is the double entry? Debit asset, because normally when we say revaluation, we mean upward revaluation. Normally, debit asset, debit accumulated depreciation. Now what is this? Credit revaluation surplus. Credit revaluation surplus. Now debit asset is actually the increase in value. Debit accumulated depreciation means we are de-recognizing depreciation, and credit revaluation plus that means other components of equity, other comprehensive income and equity. Now remember this thing, that when we are doing the revaluation, we will be de-recognizing previous accumulated depreciation. So that means when we charge the accumulated depreciation, you remember when we do the entry, we do this entry: debit depreciation, credit accumulated depreciation. Debit depreciation means that this is the expense going in the profit or loss. Credit accumulated depreciation means that we are accumulating it in the T account in order to calculate the net book value at any time. So for depreciating asset, debit asset, increase in the value. Debit accumulated depreciation because we are de-recognizing finishing previous depreciation, and credit revaluation surplus. Now let's do an example. You can understand it quickly. Like an asset bought for $100,000 on 1st January 20x7. Useful life is 10 years. The asset was revalued. The asset was revalued on 31st December 20x9. That means after 3 years. The asset was revalued on 31st December 2009 x9 at 1,20,000. So show accounting entries. An asset bought for 100,000 on 1st January 2007. Useful life is 10 years. The asset was revalued. Now I told you that whenever we are doing the revaluation, we need the carrying value at revaluation date. We need the carrying value at revaluation date. Now how we can calculate the carrying value? 100,000 minus 30,000. Now where this 30,000 is coming? Because the 100,000 is the cost, useful life is 10 years. So per year depreciation is 10,000. So 20x7, 20x8, and 20x9, because we are doing revaluation in 20x9, after 3 years, the carrying value is 70,000. Then we have the revalued amount, which is the fair value. Now the fair value is 1,20,000. So difference between the carrying value and the fair value is revaluation gain. Revaluation gain, which is 50,000. And this will be recorded in the other comprehensive income and the revaluation surplus. Now what is a double entry? I told you debit asset, debit accumulated depreciation, credit revaluation surplus. So revaluation surplus will be credited by 50,000 because this is the gain. Accumulated depreciation was 30,000. So we are de-recognizing it. Then asset will be debited on 20,000. Now, why the asset is debited on 20,000? Because remember one thing, that the cost of the asset was 100,000. And in the ledger, the asset is at cost. Now, asset has moved to 1,20,000. So the movement in the ledger should be of only 20,000. That means 100,000 to 100,000. So you see that credit revaluation surplus 50,000, debit accumulated depreciation 30,000, asset automatically comes for 20,000. And this is the movement, because in the ledger asset was on 100,000 and the market value is 120. So it moved from 100 to 120, which is only the 20,000 movement. So this is how we do the double entries of the assets: debit asset, debit accumulated depreciation, and credit revaluation surplus. Now why we have de-recognized the depreciation? Because after revaluation, depreciation is charged on revalued amount and remaining useful life. After revaluation, depreciation is charged on revalued amount and remaining useful life. Now after revaluation, depreciation is charged on revalued amount and remaining useful life. Now what is the revalued amount? Now the revalued amount is 1,20,000. And what is the remaining useful life? Now the remaining useful life is 7 years, because 3 years are now done and we have done revaluation after. So now the depreciation will be 1,20,000 divided by 7, which is 17,143. Now this is the new depreciation. After revaluation, depreciation is charged on the revalued amount and remaining useful life. So debit depreciation and credit accumulated depreciation 17,143. That is why we are de-recognizing previous depreciation, because after revaluation, depreciation is charged on revalued amount and remaining useful life. So this is how we show the double entries of the revaluation. Alright, so now we have studied that after revaluation, depreciation is charged on the revalued amount and remaining useful life. Now you remember that the revalued amount was 1,20,000 in the question which I gave you. An asset bought for 100,000 on 1st January, useful life is 10 years, the asset was revalued to 1,20,000. So this was the revalued amount. and it has been already depreciated 3 years. That is why the depreciation was 30,000. So now the remaining life is 7 years. So after revaluation, depreciation is charged on the revalued amount, which is 1,20,000 here in this question, and remaining useful life, which is 7 years in this question. So after revaluation, depreciation is charged on revalued amount and remaining useful life. Now there is another concept related to this, which is transfer. Now this is transfer from revaluation surplus to retained earnings. Transfer from revaluation surplus to retained earnings. That means making unrealized gains realized. Now we have to understand this concept. Look, the gains we have, like in this question, we were having a revaluation gain of 50,000. This revaluation gain is recorded in other comprehensive income. And we know where is this other comprehensive income. This comes under the profit for the year, and these are known as unrealized gain. Now, this gain will be realized when the asset is sold. And when the asset will be sold, in this example, it will be sold after 7 years. So that means this gain will remain in the revaluation surplus for these 7 years. And after the seventh year, after these 7 years, when we sell this asset, it will become realized. So the problem with this thing is that after 7 years, the seventh year income statement will show the immediate gains. So the standard says that we are depreciating the asset based on the concept that the cost should be spread over the useful life. So why not we do the same with these gains? We take the gain and we spread it over useful life. Now, what is the gain in this question? The gain in this question is 50,000. The remaining useful life is 7 years. So what we do is 50,000 divide by 7. It gives you 7142.8. Now what we do is every year we do revaluation surplus. That means we take out 7143 from that and we record this in the retained earnings. 7143. In this way, the gain will be spread over the useful life rather than realizing it in the seventh year. So this is the more better view of presenting the gains, that the gain we are having over here should be spread over the useful life. So every year we take the gain from the revaluation surplus. That means de-recognizing the unrealized gain and making it realized. This can be shown in some other way. The other way to show is that what was the old depreciation? The old depreciation was 10,000 if you remember. What is the new depreciation we calculated? The new depreciation we calculated is this 17143. Now what is the difference between these two? The difference between these two is the same amount, this one 7143, which we have transferred every year from the revaluation surplus to retained earnings. So that means there are two ways to calculate this amount. The first way to calculate this amount is spreading the gain over the useful life. The second way is to compare old depreciation with the new depreciation. So the concept is that we are not recording the immediate gains after the useful life. Instead, what we are doing, we are spreading the gain over the useful life. It shows a more better view, and it records the gain throughout the useful life rather than recording it in the 7th year. All right, so now we'll be doing the rest of the standard. And in the rest of the standard, the first thing you have is the disposal of PPE, property, plant, and equipment. So the first thing you have in the disposal is that the transfer of control. Now, we discussed the control in the last lecture, that this is the criteria of the asset. Uh, Not specifically mentioned, but it is a criteria of the asset that we should have the control. Now, control means the risks and rewards. So if the entity is disposing the asset, that means this should be transferring the controls to the entity to which they are selling the asset. The transfer of control, and there should be no managerial involvement. Now, managerial involvement means that they should not have any sort of involvement in that disposal. For example, if the company is selling the asset and they include a clause in the contract or the agreement that we'll be using this asset as well. So that means this is not a disposal because they have not transferred the control to the entity to which they are selling. Similarly, if they have a clause that we can rebuy this asset, repurchase this asset after 3 years, now that means they have not transferred the control to the entity. So if the entity wants to record the disposal, the first thing they need to make sure is that they have transferred the control. Now, control means they have transferred all the risk and rewards associated with that asset to the buyer. But if the entity have any sort of involvement till now, that means it should not be recorded as disposal. So the first thing, the transfer of the control. Now, once they have transferred the control, the asset should be removed from the asset register because they no longer own this asset, they no longer control this asset, so it should be removed, and the gain or loss on disposal should be recorded in the profit or loss. Because they are selling the asset, either they will be selling it on gain or loss, it should be recorded. Now, whenever the entity is selling the asset, they will be making a disposal account. And you have studied this thing so many times in your accounting paper. We'll just discuss again. Disposal account. So, asset, accumulated depreciation because it will be de-recognized. Proceeds, and if the balancing figure is coming on debit side, this is the gain. And if the balancing figure is coming on the credit side, it is the loss. Sorry. Now, what are these entries which are recorded in this T account? Obviously, this T account has the entries. the journal entries. So when we are disposing the asset, we'll credit the asset because the decrease in asset is credit, debit disposal. So the other entry goes in the disposal account. We are de-recognizing the depreciation, so accumulated depreciation debit, disposal credit. We are receiving the cash, so cash or bank debit, disposal account credit. Now, if it is sold on the profit, so debit disposal account, credit profit or loss, because when we charge the gain in the income statement, we credit the profit or loss. If it is sold on the loss, then debit profit or loss and credit disposal. So these are the double entries. This is the gain, this is the loss. So these are the double entries which we have recorded in the disposal account. Now, there's no need to remember this account, it's just for the basics. So whenever the entity is doing the disposal, what they're going to do, they should calculate the carrying value of the asset at disposal date. And this is then compared with the proceeds, the amount they get on the sale of the asset. So any difference between these two is the gain or loss. So remember this thing that when the entity is selling the asset, so the first thing should be that there is a transfer of control. Then if there is a transfer of control, the asset should be removed from the asset register and gain or loss should be recorded in the profit or loss. The entity makes the disposal account for calculating the gain or loss, and these are the journal entries which are depicted or showed in the ledger. And whenever they want to calculate the gain or loss, simply what they're going to do is they calculate the carrying value of the asset at disposal date and they compare it with the proceeds that give them the gain or loss. Now we have the disposal of a revalued asset. Disposal of a revalued asset. Disposal of a revalued asset. Now, you remember that in the last lecture, we said that when the entity revalues the asset, there will be a revaluation surplus. And that revaluation surplus is recorded in the statement of changes in equity or the equity section of the balance sheet. There we have the revaluation surplus, and those are unrealized gains. Although we have a policy sometimes that we transfer the gain from the revaluation surplus to the retained earnings, but not every company do that. So the disposal of the revalued asset, when the entity is disposing the asset, what they're going to do is they debit the revaluation surplus because now this asset has been sold. So the revaluation surplus should be de-recognized and all the revaluation surplus is transferred in the retained earnings. So if you see, effectively, there is no change. That means it is moving from one equity section to the other equity section. Like for example, if you have the statement of changes in equity. So here you have, for example, the revaluation surplus. Here you have the retained earnings. So what we're going to do is we deduct the revaluation surplus from here and we record in the retained earnings. So this is a transfer from the revaluation surplus to the retained earning. when the asset is sold. So that means, in other words, we can say that the unrealized gain is actually realized. So the unrealized gain is actually realized. Okay, then you have a next concept, which is overhauling. Overhauling. Now, overhauling, such as major inspection. So what is the treatment? The expense is capitalized and then depreciated systematically. Expense is capitalized as a separate component. Separate component. All right, now let's understand this thing. Now, say for example, there is an airline industry. The airline industry, for example, Emirates. Now, the Emirates have the planes, which are their property, plant, and equipment, because they are using it to provide the services. So those assets are generating revenue for the Emirates. So those planes are the property, plant, and equipment, because those planes are not for the sale. Those planes are not for the capital appreciation. Those planes are not for the rentals. Those planes are generating revenue for the entity in the ordinary course of business through use and not through sale. So overhauling, such as major inspection, the expense is capitalized as a separate component. Now, for example, planes. Now, there is a legal requirement most of the times that after a specified number of flying hours, they need to overhaul their asset. They need to inspect their asset. For example, after 10,000 flying hours, they need to inspect their whole plane for the security purposes, safety purposes. So a team will be coming and they will be checking the whole plane, major inspection, overhauling. Everything will be checked. And obviously, when they are checking the whole plane after a specified number of flying hours, they will be charging a fee for that. And that is the expense of the company. For example, after 10,000 flying hours, they are inspecting their planes and they pay $100,000. Now, those $100,000 is actually the expense of the company. But that expense should not be immediately expensed out. So what we're going to do, the expense is initially capitalized and then we depreciate it systematically. For example, they spent $100,000 on the major inspection. And in this year, they have used only 5,000 flying hours. So half of that expenditure will be expensed out. Now let me write this thing in order to make it clear. For example, inspection of the airplane after 10,000 flying hours. All right, and the ABC company spent $100,000 on major overhaul or, for example, inspection. Now, what are they going to do initially? they're going to debit the asset, credit cash with this 100,000 because initially we will capitalize it. So say for example, for the year ended 31st December 20x9, they flew 5,000 hours. Now what they're going to do is 5,000 divide by 10,000, which is the total number of hours, multiply by 100,000. So this gives them $50,000. So this will be expensed out as depreciation. So that means the concept is that when the entity is doing the overhaul, any type of overhaul, so they are spending some amount on it, that expense should not be immediately expensed out. So the concept is the concept is that the expense should not be immediately expensed out. Rather, it is capitalized and depreciated systematically. So if the entity is immediately expensing out that expense, so that means this is the incorrect treatment. Now the last thing in this standard is complex asset, complex asset. Complex asset is an asset whose components are having different useful life, so depreciated separately. Again, for example, airplane or aeroplane. Engines, there are two engines, for example, so having separate life, primary engines, secondary engines, and interior, exterior, navigations, etc. So you know, plane, when you have the plane, aeroplane, it's a complex asset. We cannot depreciate the whole plane together because every component of the plane is having different useful lives. Interior having different, exterior having different, engines having different, navigation having different, the IT things. And nowadays the planes are too much advanced. You see that they have the screens in it, or right in front of the every seat. They have the proper screens in which they have the movies and things like that. So proper interior and then things like that. So engines, interior, exterior, navigation, etc. So complex asset is an asset whose components are having different useful lives and so depreciated separately. So what they're going to do is they will depreciate the things separately and then they take the whole depreciation. How? So for example, you can just make the schedule for yourself. For example, you just write engine 1, engine 2, and then interior and then exterior, etc. So then you divide these separately, and this is going to be the total. So this is cost and accumulated depreciations. And it gives you then the collective carrying value. So this is the remaining part of the I-16, in which you have the disposal, you have the disposal of the revalued asset, you have the overhauling, and you have the complex asset. All right, so now we have another standard which is quite related to IAS-16, and you will see that there are so many things which are similar. That is IAS-40, investment property, which I gave the introduction as well. And investment property. Now, investment property, again, these are the tangible non-current assets. IAS-16 is also the tangible non-current asset. But IAS-16 tangible non-current assets are for the business use. So we are using those assets in IAS-16 for generating the revenue through use. So they are actually in the business use, either in the production or to provide the services. But here IAS-40, it's a property, which means land or building or both. IAS-40, investment property, which is land or building or both, held for, now held for what? Held for capital appreciation or to earn rentals or both. So that means we are currently studying the scope of the standard, that which assets will be classified in the IAS-40. So it is a property, land or building or both, which is held for capital appreciation. Now, capital appreciation means that we want increase in the value of that. Like say, for example, if the company has bought a piece of land and the intentions are that currently the market value is this, after 1 year it will increase in the value, and then we will think whether to sell it or something like that. So currently they want increase in the value of the land. That is known as the capital appreciation. A lot of people do that individually as well. They buy the plots, they buy the land, and the intentions are that the land will increase in the value. To earn rentals, for example, the company bought a building and they gave it on the rent. But remember one thing, that their business should not be the rentals. Rental means, like, for example, they are having the surplus properties. They have the surplus properties and they have given in the rent. But for example, if they have the business of the rentals, for example, there is a housing society and they have the houses which they give on rent. So now rental income is their business. In that case, those properties are generating revenue in the ordinary course of business. Then that will come under IAS-16. When we are talking about the rentals here, that means we have some surplus properties and we do not have any rental business and we have given on the rent. Then that in that case we will be classifying this under IAS-40. So again, I'm going to repeat it. If the rentals is the business of the entity, then those properties will be covered under IAS-16. If they have given the building on the rent and it's a surplus property, something like that, and their business is not rentals, then it will be classified in IS-40. So IS-40 investment property, land or building or both, held for capital appreciation or to earn rentals or both. So this thing will be classified under IAS 40. Now there's one more thing. Or a property whose intended use is not yet defined. Property, land or building or both, held for capital appreciation or to earn rentals or both. Now this is quite simple. The second point is a property whose intended use is not yet defined. Like say for example, company bought a piece of land. Now they are now they are deciding whether to sell this land, whether to keep this land and have some increase in the value, whether to build something on it, such as a warehouse or a building on that. So they are yet in a phase of deciding what to do with the land. They have not decided yet whether it will be used in the uh, you know business use, whether it will be kept for capital appreciation. They are in a phase of deciding. So in that case, the property will be classified under IS-40 as well. So any property whose intended use is not yet defined. So this is the scope of the IS-40. Now, initial measurement. Now we came to know that which properties will be classified, and after that we should know at what amount the initially investment property should be recorded. So initial measurement, just like Ias-16, will be at cost. So the same thing we studied in Ias-16, initial measurement. Then you have subsequent measurement. And then you have the subsequent measurement. So in the subsequent measurement, there are two models. Cost model, which was in Ias-16 as well, fair value model. But this fair value model is different from the one in Ias-16. So cost model is same, just like Ias-16. Cost less accumulated depreciation. So this is the same like you did in Ias-16. It gives you the carrying value. Then you have the fair value model. It is different from the one which is in Ias-16. So it's different in two ways. The first thing, the gain or loss is recorded in the profit or loss. If you remember, when we used to revalue in Ias-16, the gain or loss was recorded in the other comprehensive income, which is after the profit for the year. Now this is investment property. Any investment property which is carried out at fair value model, the gain or loss will be recorded in the profit or loss. That means it is above the profit for the year. These are the realized gains. In Ias-16, we were having unrealized gain, which was recorded in other comprehensive income. The second difference is no depreciation. In Ias-16, in the revaluation model, we used to depreciate the asset. Remember that we said that depreciation is charged on the revalued amount and remaining useful life. But in the fair value model in the Ias-40, the properties or the whatever land or building, whatever you have classified over here, is not depreciated. So two differences. The gain or loss is recorded in the profit or loss. And the second difference is that there is no depreciation. Now remember this thing as we said this thing, or a property whose intended use is not yet defined will be recorded in Ias-40 at fair value model. So any property whose intended use is not yet defined, so it will be classified as Ias-40 in the fair value model. And the fair value model is that we have the value at each reporting date. We remeasure the asset, we take it to the market value. Any gain or loss is reported in the profit or loss, and we do not charge any depreciation as well. Now the accounting entries are quite simple. So if there is a gain, debit investment property, credit profit or loss. So this is the gain, and if there is a loss, debit profit or loss, credit investment property. This is the loss. So these are quite simple entries and no depreciation. Then we have another thing in this standard which is known as transfers. Now is transfer is from Ias-16 to Ias-40. Now say for example you were having a building which was used for the office. Now you built a new building and you shifted your office over there, and the previous building is given on the rent. So that means the property has been transferred from Ias-16 to Ias-40. Similarly, vice versa. Ias-40 to Ias-16. For example, there was a property which was given the rent, and now you decided to have your own office over there. So Ias-40 to Ias-16. And then you have cost to cost model. Like as I said, that in Ias-16 and Ias-40 cost model is same. So the property is transferred from Ias-16 to Ias-40 and cost to cost model. In Ias-16 it was on the cost model, and even in the 40 it is going to be carried at cost to cost model. So it is cost to cost model. Revaluation to fair value model. Now these models are different obviously. Again here, Ias-40 to Ias-16, cost to cost model, and fair value to revaluation model. So now we'll be looking at the treatments one by one. So Ias-16 to Ias-40, cost to cost model. So no change as the cost models are same in the both. If it is transferred from revaluation to fair value model, then revalue the property, or you can say revalue the asset at transfer date. Like the date on which you are transferring the asset from Ias-16 to Ias-40, it should be revalued. Now revalued means that it should be brought to the market value. Revalue the asset at transfer date. gain or loss is recorded, any gain or loss is recorded in other comprehensive income because the property is still under Ias-16. So any gain or loss will be recorded in the other comprehensive income. Then transfer the asset, transfer the asset to Ias-40 on revalued amount, which is the market value. Transfer the asset on the fair value to Ias-14. Subsequent gain or loss. Now, any gain or loss which is coming after the transfer, subsequent gain or loss will be recorded in profit or loss because now the property is in Ias-40 and no depreciation further because in the Ias-40 fair value there is no depreciation. So now again I'm going to revise it for you. If the property asset is transferred from cost to cost model, there is no change because the cost model is same in the both standards. If it is transferred from the revaluation to fair value model from Ias-16 to Ias-40, we are going to revalue the asset at transfer date, at the date on which we are transferring the asset from revaluation model to fair value model. Any gain or loss is recorded in OCI because the property is still in Ias-16. Then transfer the asset on revalued amount. Now this means debit investment property, credit PPE, that we are removing it from PPE, we are recording it in the investment property. Any subsequent gain or loss will be recorded in the profit or loss because now it's IAS-40. No depreciation as no required in Ias-40 fair value model. So again, the second thing, if the property is transferred from the cost to cost model, no change because the cost models are same. If it is transferred from fair value to revaluation model, that is Ias-40 to Ias-16, again revalue the asset at transfer date. Gain or loss, any gain or loss is recorded in profit or loss because the property is still in Ias-40. Then transfer the asset to Ias-16 on revalued amount. Subsequent gain or loss will be recorded in other comprehensive income because now the property is in Ias-16 and depreciated as well because Ias-16 allows the depreciation to be charged on the revaluation model. So look, if the property is transferred from fair value to revaluation model, revalue at the transfer date. Let's compare these two. Revaluation to fair value model, fair value to revaluation. The first step is same. Revalue at transfer date in both. Here the gain or loss is recorded in other comprehensive income because the property is still in Ias-16. Here it will be recorded in profit or loss because the property is still in IS-40. Let me write it as well. So still in IS-40. Then transfer the asset to Ias-16 on revalued amount. So here the entry will be debit PPE credit investment property. Any subsequent gain or loss will be recorded in other comprehensive income because now it's in IAS-16. Depreciated as well because IAS-16 allows the depreciation. Now the last thing in this standard, is disposal of investment property. Disposal of investment property. Now this is quite simple. Disposal of investment property is when it is disposed, debit cash or bank. This is the proceeds, the amount they got, and credit investment property. This is the carrying value, derecognized. Now, if the balancing figures comes on the debit side, this means the loss. If the balancing figures come on the credit side, this means the gain. So disposal of the property, plant and equipment. You derecognize it, you record the proceeds and the relevant gain or loss in the profit or loss. So this is IAS-40, and you know it is quite similar to IAS-16 in many regards.